Chairman sir, it's 4. Can we start?
हाँ
Give us reverse countdown.
5, 4, 3, 2, 1. Please start, sir. We are live now.
A very good evening to you all, friends. I'm Sanjeev Singhal, Central Council member from the Northern region and Chairman Auditing and Assurance Standard Board, Vice Chairman Committee for Member in Industry and Business. I welcome you all to this 103rd program of AASB for this council year. Friends, before I talk about the subject, I would like to apprise you that AASB has started 2 helpline. One is on the bank audit related queries, which was operational from April 1 till the end of this day, April 30th. And second is for the audit of the corporate entities as well as non-corporate entities. And this helpline is available from April 16 to 30th September. Please feel free to write to our experts and they will respond within 24 hours to 48 hours time. And there is no fee for this service. Friends, apart from this, ICAI, the Auditing and Assurance Standard Board, has also brought out 2 publications. One, a checklist on auditing standard, and second is the working paper templates. Please make best use of these. Friends, now let me talk about today's topic. In the beginning this month, we started a series for key consideration in audit of the listed companies. And we have picked up various topics, and today it's the 8th webinar on such topic. And today's topic is reports or certificates for special purposes. To deal with the topic, we have 2 very experienced faculty, CA Nitin Gupta and CA Nilanjan Paul. They have taken many sessions for ICAI, and we really thank them for taking out their time and appreciate their imparting of the knowledge. And we have 2 moderators today, CA Shilpi Jain and CA Vipul Kumar Goel will join shortly. I thank both of them. May I now request CA Shilpi Jain to kindly take it forward and invite our speakers for deliberations. And I'm also thankful to the AASB staff led by Anil Lalji for organizing these programs so well. Thank you.
Thank you so much, sir. CA Dr. Sanjeev Kumar Singhal, Chairman of the Auditing and Assurance Standard Board of ICAI, and CA Vishal Doshi, Vice Chairman of the Auditing and Assurance Standard Board of ICAI, for giving me this opportunity as a moderator. Good afternoon, everyone. I welcome all the participants to this webinar, which is related to key considerations in audit of listed companies organized by Auditing and Assurance Standard Board of ICAI. As you all know, audit of listed companies are going on. So this webinar would definitely help you in conducting your audit in an efficient manner. Now I welcome speakers for today's webinar, CA Nitin Gupta and CA Nilanjan Paul. CA Nilanjan Paul is a seasoned chartered accountant with 17 years of post-qualification experience in a wide range of accounting and auditing matters. He has significant experience in assessing financial reporting implications arising from complex and judgmental matters such as going concern and non-compliance with laws as regulations. CA Nilanjan Paul is a speaker in various established platforms, including the Indian Institute of Corporate Affairs set up by the MCA, and he is also involved in providing point of view on emerging issues such as reporting under Companies Act and SEBI listing regulations. He has also experience in handling capital market transactions. He has also published point of view on emerging topics in leading publications having national presence and speakers at various forums. He is also an avid traveler and a serious photographer. Now I introduce CA Nitin Gupta. CA Nitin Gupta is a chartered accountant with over 18 years of experience in financial statement audits and other assurance engagements. He is a partner with ASC and Associates LLP New Delhi. His experience spans Indian and foreign corporate, including some large listed entities across various sectors with food processing, pharmaceuticals, industrial components, consumer products, etc. CA Nitin Gupta is a frequent speaker at trade chambers and ICAI study circles and webinars. He was special invitee to ICAI's Expert Advisory Committee for year 22-23. CA Nitin Gupta is also a US CPA and a Bachelor's in Commerce from Mumbai University. So now I request CA Nitin Gupta ji to join the deliberation and enlighten our participants. Thank you very much. Happy learning.
Thank you, Shilpi, for the warm introduction. And thank you, Sanjeev ji and ASB, for giving me an opportunity to take this webinar. And I welcome all the participants to join this webinar. So this topic, it's a part of the series on key consideration in audit of listed companies. So till now, before this, 7 topics were deliberated across LODR, CARO 2020, Schedule 3, internal financial control, audit reports, risk assessment. So if we look at this entire gambit, so it's everything moves around audit, statutory audit. Now being this topic, which is more specific to the certificates and special reports. So one may wonder why this topic. So at the end of the day, certificates are also an assurance engagements. If we look at the entire most of the practicing chartered accountants who are rendering assurance service, so irrespective of the size of the company or clientele what they deal with, they do across in and out, like on the certificates work, keep on receiving requests from their client to issue the certificates, and at the end, certificate being an assurance engagement by the chartered accountant. To it also covers the same set of responsibilities and ownership for any chartered accountant who is issuing the opinion. So that's why we are deliberating this, more specific to the listed companies, the certificates, what as an auditor of a listed company one may come across. So this is the sense, and as a part of the flow of the presentation, I and my co-speaker Nilanjan, we were deliberating as to what will be the flow of this particular session. So should we cover more on the guidance note on reports or certificates for special purpose, which has been issued by ICI in 2016. So should we take the guidance note, discuss the intricacies of the guidance note, or something else? But both of us felt that otherwise it will be too academic in nature, taking the guidance note and then flowing the discussion. So rather it will be more value add to all of us to straight away take the couple of certificates. I will take a couple of others will be taken by co-speaker, and we can display or we can run through the certificates as such, and then during that certificate only I will go through the key aspect of the guidance note. So this will be the flow of my presentation. And to start with, as a brief on certificates. So we do come across many times by the client to receive a request from the client to issue the certificate. So what are certificates? Certificates are a more of a term used in a layman language. The underlying framework for the certificates or special report is the guidance note on reports or certificate for special purpose, revised 2016, issued by ICI. So this guidance note talks about the entire phase of any certificate engagement. So we'll take a very high level run through of this guidance note, and then we'll come to those specific certificates which I will deliberate. So the scope of the guidance note is to cover the assurance engagements other than the audit or review of historical financial statement. So that means any assurance engagement which are other than audit or review will cover under this guidance note, except if there are specific guidance note or auditing standard which deals with assurance engagement specifically, then those also will be moved out. Rest everything will sit across in this particular guidance note. So this is quite wide in its nature. And if we look at the guidance note, So it talks about pre-engagement process, engagement formalities, agreeing the terms with the management, then planning aspect related to the given certificate, what all to be included in the planning, how the team need to plan for the given certificate work, execution, then comes the review process, the conclusion, what will be the reporting format, what all to be included in the report. This is everything is defined well in a sequential order in the guidance note. And then what kind of documentation one need to have, what about the written representation and follow-up things. So it is as good as any other assurance engagement, be it audit or review. So please keep in mind that it's not just issuing the certificate, that's it. It requires interface of an assurance engagement. So we'll take this from now. Let me put up on the screen the certificates what I will cover, and then we can deliberate more on that. Yeah, fine. So I will be covering 3 certificates. The first one will be on net worth certificate. Second one will be on accounting treatment prescribed in the draft scheme as a part of, say, restructuring. And third one will be annual performance report, which as a part of FEMA regulation, the holding company need to submit for its subsidiaries. So these are the 3 certificates which I am going to cover. Per se, they are not only meant for listed companies, they are equally applicable for unlisted company also. But it is imperative that we all deliberate and get into essence of these certificates. So it will cover the, be it listed or unlisted company, and my co-speaker, he will then take up the other certificates which are more particularly for the listed companies. So this is how we have divided the deliberation among ourselves. So let me start with net worth certificate. What you can see is the basis for this certificate, that ABC Limited is the client, is the company for which say I'm the statutory auditor. So ABC Limited is bidding for a proposal, request for proposal issued by XYZ Limited. And as a part of the RFP requirement, ABC Limited is required to submit net worth statement as at March 31st, 2024, duly certified by their statutory auditor. ABC Limited has computed the net worth calculation in accordance with RFP and shared the draft with their auditors for verification. Statutory auditors has already issued audit opinion for the year ended March 31st, 2024, prior to issue of net worth certificate. So these are the situation for this particular certificate. And now say I am from the audit firm and who is like auditing ABC Limited. We got the request from the management that they are bidding, and as a part of RFP, they need to submit net worth certificate. And so the first thing what I need to do is to check with my appointment formalities. Being an audit client, we believe that my client acceptance and my independence check, that everything has been done, already being done, since I am issuing the audit opinion as well. If that is not done, so one need to get into that as a part of the firm's audit quality policy, and which is in line with SQC 1. So on those aspects, one need to first start with those engagement formalities. Once that is done, then the engagement letter for this certificate need to be exchanged with the client. We'll cover this once we go through the certificate. And then once this is done, now I will start plan for this certificate work. So the first thing to start with is we will get the copy of request for proposal. We'll go through the entire RFP and understand that where is the requirement coming for the issue of certificate on net worth. So have a read of that particular clause and then make yourself familiar that what is the requirement, what is the manner of computation of net worth given in the RFP, and then proceed accordingly. See whether at which date net worth is required calculation. So it may be as per the latest audited financial statement. And we presume that March 31st, 2024 financial statement has already been audited and issued. So we'll take that as a base. And then we'll exchange the discussion with the client, issue the preliminary information requirement list, what we called as a IRL with the client. And then we will obtain the information. So that's everything will come as a part of planning for this particular engagement. Once we have done the work, and then our draft is ready with, so this is the, I would say that draft certificate. This is more of a format in nature. So it is very important to understand to whom the certificate need to be addressed. So there are two different parties to this. One is the engaging party. So ABC Limited is the engaging party, and we must have exchanged the engagement letter with ABC Limited. So hence they are the engaging party, and then need to understand to whom we need to issue the certificate. Will it be the same engaging party or say to the company who has issued the RFP? So that means XYZ Limited. We presume in this case that it was not the requirement in the RFP to address the certificate to XYZ Limited. So that's why we have mentioned the addressee as the Board of Directors ABC Limited. Otherwise, it could have been addressed to the XYZ Limited. In that case, we need to be more careful because this is a third party to whom the certificate will be addressed. Right now, for our discussion purpose, this is addressed to ABC Limited. Independent auditors certificate on net worth of the company as at March 31st, 2024. This is the heading. Now, why we are mentioning independent auditors? Because the same firm who is issuing this certificate is the auditor of the ABC Limited. So that's why the title is Independent Auditor Certificate. There can be a situation where the certificate is being requested and issued by the non-auditor. Okay, if the underlying regulation or the requirement states so, in that case, instead of word auditor, it will be practitioner. So then independent practitioner certificate, and across the certificate, the word auditor will be replaced by practitioner. This is what is referred in the guidance note. Now, the first para is the introduction. We have been requested by ABC Limited wide engagement letter, a mandate letter dated October 20, 2023. So what is engagement letter, a mandate letter? Generally, when the engagement letter for the statutory audit is exchanged, it also includes the scope on certificates and a very brief about the management responsibility and auditor's responsibility in that same EL, which is there for the statutory audit. If that is the case, then as and when the auditor is receiving the request from the company to issue the certificate, so then there may not be need to exchange a separate engagement letter because the master engagement letter, which is on the stat audit, that already includes the scope on certificates. So in that case, a separate short engagement letter, which again, which we called as a mandate letter, it can be from firm to firm, it differs the name. But what essentially it means, in the mandate letter, there will be a reference to the engagement letter of audit, and then the everything related to this particular certificate on net worth will be mentioned as to the purpose, where it is need to be submitted, who will be the addressee on this, what will be the reporting format, then fees will be covered here, and then other terms which are part of the engagement letter. So it will be a short version. But in a situation where, say, the audit engagement letter does not include the scope on certificates, then there will be a separate engagement letter for certificate itself. So this is how one need to interplay between engagement letter and mandate letter. And for the listed companies particularly, all these engagements require pre-approval by the audit committee. So please pay special attention while carrying out the certification work, that whether the given certification is as a part of approval process, it must be run through the audit committee for their prior approval. So that means we can meet our independence requirement. So moving further, once we exchange the engagement letter, and then this is the introductory para to certify the statement of net worth, refer statement. This we have defined in accordance with request for proposal issued by XYZ Limited for the purpose of onward submission to XYZ Limited. So this is the introduction. And then we are saying we have initialed the statement for identification purpose, because the certification is being done through this particular document, and that statement is being initialed by us for identification purpose. Then the second section will be management responsibility for the statement. Now, here, what is management's responsibility? This is clearly reproduced here, that preparation of statement is the responsibility of management of the company, including preparation and maintenance of all accounting records. And this responsibility also includes on internal control. So this is the standard wording which has been picked from the guidance note illustrative certificates. And then this third para is also taking care about that company. It is company's responsibility to comply with the requirement of RFP and provide the relevant information to XYZ Limited. So to make it very clear, like this is the management responsibility. Now comes the auditor's responsibility. It starts with that pursuant to the requirement of RFP issued by XYZ Limited, it is our responsibility to provide reasonable assurance as to whether the company has accurately extracted figures from the audited financial statement for the year ended March 24 for computation of net worth as set out in the statement. So in essence, what as an auditor we are doing, we are comparing the figures, what is there in the statement of net worth with the corresponding numbers from the audited financial. And we are issuing certificate whether those figures are accurately extracted from the audited financials, yes or no. So that's what we have mentioned the scope. And then we are also stating that the financial statement for the financial year ended March 24 have been audited by us means the same audit firm who is issuing this certificate, on which we issued an unmodified audit opinion vide our report dated April 15, 2024. So this is for the illustration purpose. Don't try to think how come in 15 days they have issued the audit opinion. This is for, again, illustration purpose only. But the important thing to understand why first of all, why there is need for this particular para. So since the underlying figures which are there in the statement of net worth, they are coming out from the financial statement. So it will be very important for the user of this certificate to understand that who have done the audit, whether the base figures are audited or unaudited, yes, they are audited, and who has done the audit, and whether they have issued the unmodified audit opinion or modified audit opinion. So, and then on which date the audit opinion was issued. So this para has its own importance, and this is how this is being drafted. Then guidance note also states that we need to summarize the key procedures which are being performed. So this would be the next para. And here we are mentioning that figures mentioned in the computation of net worth in the statement of with the audited financial verified that the computation is in accordance with the method of computation set out in clause so and so of RFP issued by XYZ Limited. Now again, these are the for example purpose, team may add more procedure what they have done. Okay. Then this is also requirement of the guidance note to mention the underlying framework. So that's why this is also a standard wordings which one can find in any certificate. We conducted our examination in accordance with guidance note on report or certificate issued by ICI. We have compiled with the relevant applicable requirement of SQC1 and other assurance and related service engagement issued by ICI. So by stating this, we are making an affirmative statement that we are complying with SQC1 for this particular certificate. Thereafter comes the opinion para. Assuming that the computation, what is there in the statement, this is in matching with the audited financial, the team has done all the ticks and the number of net worth is fine from the audited financial, then this opinion would come based on our examination as above and the information explanation given to us. We are of the opinion that the computation of net worth in the statement is in agreement with the audited financial statement and books of account of the company and is in accordance with the method of computation set out in clause so and so of RFP issued by XYZ Limited. So this is the our basically the certificate what we are giving, our opinion. And then since it's a close-ended, this is specific certificate issued for the requirement of XYZ Limited. So we'll make it restriction on use. Otherwise, this could have been issued to n number of bid parties and to anyone. So we are making it specific by stating that this is the requirement, RFP and XYZ, and at the end, it's being closed with the restriction on use. And then finally, the sign off by the chartered accountant firm. And at the down, it's enclosure, statement of net worth. So that this certificate itself may not be exchanged in isolation. On its alone, it has no use. So it should be read in conjunction with the statement of net worth. So that's how we will link it. And once this is done, then comes the statement of net worth. Now, ideally, this statement should come out from the client on that letterhead by mentioning all the figures, and then it signed off by the client. And then as an auditor, our initial would come over here, and then we can mention that initial for identification purpose, our say round stamp and our initial, because our the certificate or the opinion which we are giving is included here in this section. So nothing over this statement separately. This is how one should do carry out the procedure and drafting of the certificate whenever they are issuing net worth certificate, or it can be turnover certificate as a part of bidding process. So this is the example on this. Now, taken different situation where what if the underlying financial statement are unaudited? Okay, and then also we have been requested to issue the certificate on net worth based on the unaudited books of accounts. If that is the case, then in that situation, instead of issuing a reasonable assurance certificate, limited assurance will be more appropriate, because the underlying books of accounts on which the net worth calculation will be based are unaudited. So that's how we can reduce our risk. So rather than giving a reasonable assurance, limited assurance will be more appropriate in that case. So this is the example of same certificate on net worth, but under a limited assurance. So what will change? Just we'll discuss on that part. So under auditor's responsibility, it would be mentioned that it is our responsibility to provide a limited assurance. And whenever a limited assurance certificate is issued, so this additional para will be there as a requirement of guidance note. It draws the attention of the user that what is limited assurance. So limited assurance involves performing procedure. The procedure performed vary in nature and timing and are less extent than for a reasonable assurance. So this is important. Consequently, the level of assurance obtained is substantially lower than the assurance that would have been obtained had a reasonable assurance engagement been performed. We have performed following procedure in relation to the statement annexed. So the procedure, again, the procedure in a limited assurance should be more elaborative to mention over here. That's how it is being mentioned. And then at the end, instead of opinion, it will be a conclusion para. And under conclusion para, it will be that nothing has come to our attention that cause us to believe that amount mentioned in the statement is not in agreement with the unaudited books of account. So rather than giving a straightaway opinion that this statement is in accordance with the audited financial, here a limited assurance is being given that nothing has come to our attention. That's how the interplay between a reasonable assurance or limited assurance engagement. Fine. With this, we move to the next certificate, which is on certificate on proposed accounting treatment contained in the draft scheme. So what happens that when a company is into restructuring process, and in the given case, I picked the example of merger. So if like ABC Limited is in process of restructuring and prepared the draft scheme of merger, which includes inter alia the proposed accounting treatment. ABC Limited has requested its statutory auditor to issue certificate as per the requirement of the Companies Act on compliance of the accounting treatment referred in the draft scheme. So, as per the requirement of Companies Act, the draft scheme which is being filed with NCLT. So, in that scheme, there will be one particular section on the proposed accounting treatment, what will be done for the merger accounting. So as a requirement, the statutory auditor need to opine whether the proposed accounting treatment is accordance with the applicable accounting standard or not. So that's how the company has requested their auditor to issue the certificate. So in this case also, it will be as a part of engagement formalities, engagement letter, planning, everything say will be done by the audit team who is issuing the certificate. And here the more important part is whether the accounting treatment, what is proposed in the scheme, whether this is in accordance with the underlying accounting standard or not. So that will be the base for this certification work. So this will be the draft format for this certificates. So independent auditor certificate on proposed accounting treatment contained in the draft scheme of merger of ABC Limited with the respective shareholder. Under section 232, the applicable section can be retained. Read with other applicable provision of Companies Act and rules framed thereunder. And here the introduction part, we chartered accountant, the statutory auditor of ABC Limited has been requested by the company wide engagement letter dated so and so to certify the proposed accounting treatment specified in clause of part dash of the draft scheme of merger and this is defined as the draft scheme amongst the company and XYZ Limited and their respective shareholder. I'm just reading the key part here with reference to its compliance with the applicable accounting standard under Section 133 of the Act for the purpose of onward submission to Stock Exchange, SEBI, ROC, and NCLT. So this will be the introductory paragraph. In terms of management responsibility, so it is clearly mentioned here that the responsibility for the preparation of the draft scheme and its compliance with the relevant law and regulation, including the applicable accounting standard, is the responsibility of the management. Now, being a listed company, we presume that they are following Ind AS. So that's why the accounting standard reference is given of Ind AS. And it also says that management is also responsible for providing the relevant information to NCLT in connection with the draft scheme. So that will set the clear responsibility on the part of management. Now comes the auditor's responsibility. Pursuant to the requirement of relevant section of the Act, our responsibility is to provide a reasonable assurance as to whether the accounting treatment referred in clause so and so of the draft scheme, whether it comply with the applicable accounting standard. So this is the scope on the auditor. What documents or what procedure the auditor has performed that need to elaborate here. So like in the given case, the auditor have taken the draft scheme, then the certified through copy of the board resolution, and then finally the written representation from the management. And then the further procedure that we have verified the proposed accounting treatment in terms of section 230-232 is in compliance with the applicable accounting standard. Now, applicable accounting standard is already been defined here. Like these are Ind AS, so no need to reproduce again. And then the additional reporting as a part of framework and compliance with the SQC1. So that para are being referred here. And then when we move to opinion, so here what the audit team they need to do for this particular certificate is to look at the proposed accounting treatment and whether the treatment is clear. I mean, it is quite exhaustive. It includes step by step what will be the accounting treatment. Now the underlying Ind AS on business combination that will be governing accounting standard for this particular merger accounting. And so one need to understand whether if this is a transaction between the common control entity, so it will be a pooling of interest method, or otherwise it will be a purchase method. So the audit team, they are expected to be well through with the underlying accounting principles, and for that they may get into a consultation within their firm depending upon the criticality of the accounting treatment what is proposed in the scheme. And once they are done like with their internal review process, and then they are good to issue this certificate. And one more thing, the proposed accounting treatment what is there in the scheme, it should flow in the sequential order, like what will be the treatment for assets, for liabilities, and how the purchase consideration will be settled. So those things should come in a logical flow rather than keeping something in an implied mode or combining 2-3 things in just one sentence. So care should be taken whether that is easily understandable, because eventually NCLT will be the regulatory authority who will approve that scheme, including this accounting treatment. And for that, they would rely on the statutory auditor's certificate. So as a part of the statutory auditors, their responsibility is manifold in this, because somebody else would be relying on their certificate. So that's how the seriousness and the importance of this certificate comes into play. And once the things are fine, the opinion will be drafted accordingly. And then it also states that the draft scheme duly authenticated by the company is reproduced in Annexure 1 to this certificate. So that particular extract of the accounting scheme, of the draft scheme where accounting treatment is prescribed, so that will be reproduced as a part of annexure to this, so that this certificate itself is complete in all regard. One may not again go back to the draft scheme and refer the accounting treatment. So that will come as a part of annexure to this, which will be signed off by the management and initialed by us. And then restriction on use for this certificate. And finally, the sign off. This is how one can perform the procedures, required procedures for such kind of certificate, and then the drafting. So again, drafting one will take care, but important part is to have a understanding on the accounting treatment, what is proposed in the scheme, and whether that is in line with the applicable accounting standard or not. Moving further, I picked this very commonly used certificate or report, one can say. This is what we call as a APR, annual performance report. So this is required where a company is having a only owned subsidiaries. It can be JV or associate also, but we have picked the example of only owned subsidiary, which is incorporated outside India. And then as a part of EMA requirement, the statutory auditor of ABC Limited, they need to sign off on the annual performance report. And this annual performance report, the content of this APR is coming out from the regulation, from the relevant regulation of FEMA. And it includes one section to be signed off by the company. And on that same set, the auditors need to do their sign off. So this is how the typical format, which we will go through at the end. So in that case, we have been received the request to issue the APR. So first thing, what as an auditor we will do is to understand which all components are being included. So for each component, there will be a separate APR, and whether the component is required to get their accounts audited under the relevant regulation of their home country, and whether the audited, if yes, then whether the audited financial is being made available to us. So if that is the case, then the wordings would cover accordingly. And if it is based on the unaudited financial, then relevant section of that APR will be stacked through that this is based on the unaudited. So what important is for the audit team who is issuing this certificate to get this clarity at the beginning. And once they get the audited financial, so please have a look at the audit report also, and then simultaneously the financial statement of the subsidiaries. So that will be the base to cross-check the figures, what is there in the APR. So with this kind of planning and initial data, what the team will have, they can initiate this engagement. Now the important thing to understand here is that the format for APR is defined under the regulation. This is, let me go, yeah. This is the format, annual performance report. Now, this is as per the FEMA regulation. All this information will be filled by the entity. And then this is the declaration from the Indian entity. Indian entity is defined as the Indian company, the holding company, I mean. So they will take off the irrelevant, like what is not applicable. And then the sign off will be done by the authorized person from the company side. And then comes the certificate of the statutory auditor and the sign off. So this is the specific format, and one like the AD banker to whom this certificate will be submitted, they will not allow something additional to be written in this APR. So if that is the case, then what guidance note guides the members is, in that case, probably first we should encourage the client to get into discussion with the intended user of the certificate to accept the certificate which is in accordance with the guidance note. If that is the case, then go ahead with that. If not, then get a rejection from the relevant authority and then issue the certificate as per their format. So this is what is there in the guidance note. Now, in the given case, in case of APR, it is more logical that the certificate will be considered only in this format. Now, in that situation, what one can do? They can, like the auditors, they can draft the covering letter. So this covering letter essentially would cover the spirit of the certificate. It will include all the mandatory reporting requirement of the guidance note. So to start with, it will be addressed to board of director, and like as the word says, it is covering letter, not the certificate, because certificate is that format what we have seen. So the introductory paragraph, I'm not reading this. And this second para is important. It says that this letter has to be read in conjunction with the certificate on annual performance report issued by us on even date. So that's how we can interlink the covering letter with the certificate. And then the management responsibility. The management is responsible for ensuring that company complies with the relevant regulation of SEMA, which is defined over here. Auditor's responsibility is to provide a reasonable assurance whether the company has complied with the provision of circular and that the information stated in the report is in agreement with the books of account. Report means APR, what is defined at the beginning. And for this particular case, we have assumed that the foreign entity is subject to the audit and their audited financial statement is made available to us. In this sixth para, we are saying that the holding company, their financial statement has been audited by us, on which we have issued an unmodified audit opinion. Then the seventh para would be what all procedures we have performed and what documents we have obtained from the company for this certificate. So that in the sequential order, like one would first take the audited financial of the foreign entity. Then this is the requirement of that report, that all the repatriation from the foreign entity whatever has been done, they have been verified with the underlying documents. Then we have taken the extract of relevant ledger to see the completeness of the information what is there in the report, like that, and any other procedure if team thinks so that which will be relevant for the user, so that can be stated over here. Now this 8th para is to highlight that the audit of the foreign entity is not done by us. So we did not audit the financial statement of foreign entity. This statement have been audited by other auditor whose report have been furnished to us. Our opinion on APR is solely based on the reports of the other auditor. So this is to draw the attention. And this standard wordings on framework and SQC1. And then restriction on use. So one may wonder why the opinion is not given here, because that will cover in this APR report. So why to reproduce the opinion again in this covering letter? So that's the logic for not giving the opinion in this particular covering letter. And this will be signed off by the audit firm. So this 2-pager is the covering letter, and then comes the APR report. Now this APR report again, the format, everything is specified under the regulation. So APR, this UIN is being issued for each foreign entity. So that number need to be mentioned over here. Audit team, please do cross-check what is the source of this UIN. Many times, as a practice, we refer to the last year's APR and the number is copied from that UIN, what company will do generally. But irrespective whether this is a repetitive engagement or not, one should have the source of that UIN and as a part of audit documentation that should be kept in the documentation file for this certificate. Then capital structure as on the last date of accounting year of the foreign entity. This can be cross-verified from the subsidiary's financial statement. And if there is a change in shareholding pattern, so that also need to be specified over here. So that's again, the source will be the audited financial and as a part of board minutes of the holding company, if there is any further issue of share capital, so that will, the audit team member would generally otherwise aware as to how much is the like fresh infusion of capital in the subsidiary. So from that they can correlate. But again, the base will be the financial statement of the foreign subsidiary. And in terms of financial position of the foreign entity of last year, that means previous year and current year, this number again will be picked from the audited financial. Now, what all repatriation have been done from the foreign entity to the Indian entity, that is the holding company. So under each specified category, the numbers to be plotted separately for current year, and this is a cumulative figure. So those need to be specified. Again, the source would be the related party disclosure, and then the ledger extracts what is there in the books of the holding company. This something detail of acquisition or winding up that we are not covering for this discussion purpose. And then at the end, this is the declaration from the Indian entity. So once they are done with this, and they can strike off whichever is not applicable with their sign off. An important thing for the audit team to understand the person who is doing the sign off, how, like, what is his or her authorization to sign off this particular document. So that generally what happens when the holding subsidiary company's financial statement are being furnished to the holding company, and when the holding company is doing the compilation for their consolidation purpose. So somewhere in that, nearer to that, there will be a board meeting of the holding company where they will take the audited financial statement of all the subsidiaries, and in that board meeting only they will authorize one person who can do the sign-offs on APR and other documents. So this is the general practice. So for the audit team, they should take that resolution copy, which will give them a comfort that the person who is authorizing this particular section is the authorized person or not. Then comes the certificate of the statutory auditor. So it can be either of first or two. The first section is that APR for the year ended is prepared on the basis of audited or unaudited balance sheet. So in our case, it will be on the basis of audited. So this particular unaudited word will be strike off. And then this third clause is important. It is saying that the Indian entity has repatriated to India all dues receivable from the foreign entity. So it's not whether the dues which are recorded in the books or not. So it is, again, it's throwing more importance on this completeness. So please pay attention to this. that it's saying that whether all dues receivable from foreign entity for that particular UIN number has been is being done under the stipulated by the RBI from time to time and is being verified from the foreign inward remittance FIRC issued by AD Bank. That how it can be correlated is through not only just restricting to the audited financials, but reading out the underlying documents or the agreements which is there between the holding company and the subsidiary. So take an example, if there is a royalty agreement or there is a technical know-how agreement between the parent company and the subsidiary, and as a part of that agreement, the repatriation was to happen from the subsidiary to the Indian entity. So if that is not done, so maybe the reporting will come over here. So this is how the certificate will flow. And then this is the interlinking between the certificate and the covering letter. So here it is mentioned that to be read with the enclosed covering letter of even date. So that's how the cross-referencing will be done. And then the sign off by the audit firm. So this is on the APR. So basically I've covered 3 certificates, and this is for illustration purpose. Certificates can be manifold. There can be certificates under the requirements of SEBI, under the requirement of other statutes like Income Tax Act, GST, or when the company is bidding. So for that, there can be a requirement for certificate. But for each certificate, the underlying framework is the guidance note on reports or certificate for special purpose, and the drafting and the procedure to be followed in line with the guidance note. So this is with this I complete my speaking part, and I welcome Nilanjan, my co-speaker, to take it forward from here. Thank you.
Thank you, Nitin. I'm sure the participants would have learned a lot from your experience on certificates. Moving on to the same topic that we have today, we'll now cover some of the certificates and reports which are specific for a listed entity. So for that, I have shared my screen. And I hope the screen is visible to everyone.
Yes.
Yes, sir. Visible.
Okay, thank
Visible.
you. Sure. So as Nitin explained in quite detail, the overall content and the structure of any certificate or report as framed by the ICAI's guidance note, I thought it would be appropriate to build on that baseline which Nitin spoke of. And now we'll cover certain commonly used certificates or reports of our listed entities specifically. So on the slide, you can see a couple of them, which in my experience have been quite common. So let's start with the first one, the corporate governance certificate or report. As we all know, listed entities are required to have high degree of governance in their entire activity. Now, the SEBI listing regulations, or the LODR as we all know, lists out certain specific aspects relating to the corporate governance structure of a listed entity. This particular structure, though laid down by SEBI, is based on certain key principles which have been spelled out very clearly by the OECD in their various publications. So if you see the slide, and I'm sure you'll be able to correlate when we go to the next slide, the concept of corporate governance or the requirements of corporate governance will largely revolve on these 6 principles, which would be right of shareholders, to protect the rights of the shareholders, disclosure and transparency. Timely and accurate disclosure is very key for resolving information asymmetry. Responsibilities of the board of directors, whether they are being conducted in the way they are expected, out of from a shareholder. Last but not the least, equitable treatment to shareholders, especially the minority or foreign shareholders. Now, as far as the applicability of corporate governance is concerned, the listed entity or an equity listed entity are required to prepare a corporate governance report. These requirement to prepare a corporate governance report has been prescribed under in the Schedule 5 of SEBI LODR. The schedule also prescribes that the corporate governance report prepared by the company should be forming part of the annual report. Hence, the frequency of this particular document is obviously annual. The assurance framework, we would use the guidance on certificates and reports, which Nitin spoke of in quite detail. Now, if I look at the corporate governance requirements under the SEBI LODR, it is spelled around three buckets. If you would see the regulations 17 to 27, and there is regulation 46.2, and there is schedule 5. So these are the particular regulation which specifically states the corporate governance requirements for a listed entity. In our deliberation and discussions, we will briefly talk about a couple of them, a couple of the important ones. For example, the composition of the board of directors. The preparer or the listed entity is supposed to ensure that the mix or the composition of the board of director is appropriate and it is in line with the SEBI requirements. If I have to give some example, it is very clearly stated in the LODR that at least 50% of the board should comprise of non-executive directors. If the entity is having special right equity shares, then the requirement is much more tougher. In that case, instead of non-executive directors, 50% of the board should comprise of independent directors. Similarly, if the chairman of the board is non-executive, then 1/3 of the board should be non-independent. However, if the chairman is not a non-executive director or is somewhere related to the promoter, then in that case, a much more tougher requirement, half of the board should comprise of independent directors. Moving on to independent directors, as we all know, independent directors are supposed to protect the interest of stakeholders, especially the minority stakeholders. So in that case, it is very important that the independent directors qualify the criteria of being independent. So again, LODS describes what are those criteria. One of the most common example is that an independent director should not be related to the promoter of the entity. He should not be a promoter, or he should not be a director of the holding company, subsidiary company, or associate company of the listed entity. As far as the overall mechanism or governance mechanism is concerned, independent directors are required to have at least one separate meeting annually. So in this meeting, the meeting can be attended only by the independent directors and by nobody else. One of the criteria or one of the agenda for that meeting is to evaluate the performance of the entity and also the performance of the chairman or the independent directors. Moving on to the other things, if I have to talk about the maximum cap of entities or maximum cap on directorships, overall the LODR prescribes that one director can have directorships in maximum 7 listed companies. And again, the combination changes if he is a whole-time director or a non-whole-time director. If he is a whole-time director or a managing director in a listed entity, then he can only have directorship in 3 listed entities. We could wonder why a cap has been given or a cap has been prescribed for maximum directorships. I think the thought process behind SEBI was that that these directors form a very critical uh, component in the overall governance ecosystem, and hence they should have proper bandwidth so that they are able to diligently and objectively spend time on these listed entities. Again, on committeeships, the way we have maximum cap on directorships, we also have a maximum cap on number of committees which a director can have. So as far as the audit committee and stakeholders relationship committee is concerned, a director can have a member only in 10 such committees, that too in case of public companies. Similarly, another sub cap has been introduced uh, for directors. The other than membership in public companies, these directors can be chairperson only in 5 listed companies. So if you see on an overall basis, these are very critical structure or a foundation of a corporate governance, which the SEBI has prescribed in their listing requirements. Uh, just to sum up on some of the other key aspects, we all know of audit committee, nomination and remuneration committee, and stakeholders committee. So as far as the audit committee is concerned, the auditor would very commonly meet the audit committee at least on a quarterly basis, and it forms a very important uh, place for dialogue and brainstorming as far as the listed entities is concerned, and also to give an update on the observations, if any, of the auditors on the listed entity. If you'd see in these 3 boxes, more or less the structure or the mix is the same. But if you would see that as and when the entity has much more uh, complex structure or complex consideration, then the criteria for corporate governance is stricter. So for example, if you would look at the audit committee, it has to have minimum 3 directors and at least 2/3 being independent. Again, if an entity has SR equity shares or superior rights equity shares, the requirements becomes tougher, and in that case, the half of the committee should comprise of independent director. Chairperson should again be independent director uh, as far as the audited committee is concerned. Minimum frequency of meeting has also been prescribed, and audit committee should meet at least 4 times in a year, and the maximum gap between 2 meetings cannot exceed 120 days. Similarly, if you would look at nomination and remuneration committee and stakeholders committee, they are largely the same. Again, the same principle if there is a complex shareholding pattern or a different shareholding pattern, then the governance structure changes. We, from an auditor's standpoint, look at related party transactions very closely to have a very robust mechanism for related party transaction. The SEBI LODR have also prescribed certain norms. It requires the entity to formulate a policy of materiality on identifying and dealing with related party transactions. It has also prescribed a very detailed approval mechanism, and it goes by 3 tiers. The first set of approval is by the audit committee, and mind you, these approval are prior approval under the SEBI LODR. And second important consideration is that the related party transactions can only be approved by those members who are independent directors. So again, a separate check has been introduced or has been established by the SEBI LODR. Now, there are also various thresholds for transactions with connected parties. So for example, instead of giving a loan to the promoter entity directly, the money is given to an entity who is completely unrelated to the group, but ultimately they are somewhere linked with the promoters group. Even in that case, there are specific considerations or specific aspects which the SEBI LODR has prescribed, and this should be considered by the entity while performing the approvals of the related party transactions. Similarly, there is also a requirement to obtain prior shareholder approval. Sorry. As far as the subsidiary companies are concerned, again, for material subsidiaries, there are certain information which are required to be mandatorily placed on the board of the listed company. If more than 20% of the assets of the listed of the subsidiary is proposed to be sold, then the prior approval of the holding company is also required to be taken. So after that, when annually the listed entity would prepare the corporate governance report, the practitioner or the auditor would give a assurance report on that document. So let's see what are those common procedures which a practitioner would perform. Obviously, they would read and understand the information prepared by the entity. They would verify the composition of the board of directors, whether the mix is appropriate as far as executive, non-executive, and independent directors are concerned. They will read the minutes of the meeting of the board or of the committee. They would verify the register of directors. They would also verify whether there is an independent women director on the board of the listed entity. They would also obtain and understand the policy of related party transactions. They would obtain necessary declarations from the directors. We see that under 164(2) of the Companies Act 2013, the directors are supposed to affirm compliance with certain norms. So that should also be considered by the auditor while looking at declarations. The auditor might also obtain year-end confirmations from related parties as far as the balances and transactions are concerned. They would also look at the minutes of the meeting of the committee and whether such related party transactions have been pre-approved by the audit committee. So in a nutshell, these are the common procedures which you would expect an auditor or a practitioner to look at or perform when they are giving an assurance on corporate governance. Now, moving to the next certificate or report, there is a new requirement that is known as business responsibility and sustainability reporting. As far as the management or the listed entity is concerned, this requirement had been applicable since last 2 years. We are in the second year of that cycle of preparing business responsibility or sustainability reporting, or BRSR is concerned. Mind you, this reporting is applicable only to top 1,000 listed entities, and this requirement or this disclosure is based on environmental, social, and governance aspect (ESG) aspects of the listed entity. These are based on the national guidelines on responsible business conduct of the MCA. If you would look at the disclosure requirements, there are approximately 140 odd questions, and they are divided into 98 essential indicators, which are mandatory, and 42 leadership indicators, which are voluntary. Now, as far as financial year 23-24 is concerned, what SEBI has also mandated that that top 150 listed equity listed entities should obtain an assurance on BRSR core. So we spoke of BRSR, which is the comprehensive list of 140 questions. BRSR core is a subset of that, and it contains very limited sets of information. We have subsequent slides to talk about what those criteria or KPIs are, but from an overall concept perspective, BRSR core is a subset of BRSR. And as far as the SEBI requirement is concerned, the requirement is applicable to top 150 listed entities. Again, the frequency is annual because this has to be attached to the annual report. Now, a very interesting thing which SEBI has spelled out in their regulation is that these top 150 listed entities should obtain reasonable assurance on BRSR core. They also have a glide path and a plan to cover top 1,000 listed entities by 26-27. So if you are dealing with BRSR or BRSR core, it is very important that you explain these requirements to the management so that you have a seamless interaction as far as the reporting is concerned. What SEBI has also prescribed are value chain disclosures. Value chain disclosures would mean that if there are if you are purchasing and if you are selling your goods to a particular entities, then you are also supposed to obtain an assurance whether the activities performed by these purchasers or seller are meeting the BRSR norms or whether they are environmentally sustainable. But as far as the assurance is concerned, they are not applicable from 23-24. They would apply on 25-26 basis, but just also from a comply or explain. So if you are not able to comply from 25-26 onwards, then you are only required to make a explanation in your report in this regard. Let's talk about the 9 core attributes which forms the part of BRSR. If you would see, it is tilted primarily towards environment. You can look at greenhouse gases, water footprint, energy, but it also talks about some aspect other than environment. For example, employee well-being, gender diversity, openness of business, interactions with customers and suppliers. So these 9 boxes or 9 categories of BRSR core not only covers the ESG or the environment aspects, but they also drive the sustainability idea of a particular entity. So not only from an environment standpoint, but they are insisting the entity to behave with other stakeholders in a sustainable way. So if I have to talk about waste management, and why is it important? Because this also have some accounting implications. If you have certain wastes which are required to be collected by the entity, then you might need to assess the accounting implications as well. From an auditor standpoint, these disclosures would also require to be cross-checked with the disclosures made in the financial statements, and hence this forms a very critical information which the auditor would need to consider. Similarly, your greenhouse footprint, what are the total emissions that would need to be disclosed by the entity in BRSR core. If I have to talk about employee well-being, the entity is required to disclose how much amount has been spent from employee well-being perspective as a percentage of total well-being. Further, details of safety-related incidences that has been observed by the entity should also be required to be disclosed. Similarly, as far as the gender diversity, the gross wages of females as percentages of wages paid to males, if there are other posh complaints that the entity has received, all those would require to be disclosed. So now these 9 boxes or 9 criteria would be prepared or compiled by the entity. And as far as 23-24 is concerned, a reasonable assurance is expected to be obtained from a practitioner by the entity. Now, what SEBI has also done is that they have prescribed very strict independence norms for assurance providers. So what SEBI has very categorically said is that there should not be a conflict of interest with the assurance provider or any of its associate entity. So if I have to give you some example, the practitioner or the assurance provider cannot sell its products offer any non-audits or non-assurance services, not only to the listed entity, but to its group entities, right? Irrespective of whether the nature of the products are financial or non-financial. Similarly, they have specifically spelled out certain services which, in their view, would pose a conflict of interest, and they should be avoided by an assurance provider of for BRSR. So, for example, accounting and bookkeeping services, risk management services, investment advisory services would pose a conflict of interest, and hence they should not be provided by the uh, by the by the entity proposing to be appointed as the assurer for BRSR. Now, what would be the framework when a practitioner or an assurance provider would provide assurance on BRSR core? We have a specific assurance standard, SSAE 3000, Sustainability Assurance Standard 3000, which is an umbrella standard for all assurance on sustainability information. From an Indian standpoint, this has been built on the international assurance standard, and they are very closely aligned except for India-specific considerations. I think Nitin also mentioned about reasonable assurance. Just to reiterate, reasonable assurance is a very high level of assurance, though it is not an absolute level, but it's a very high level of assurance, and it would generally entail the assurance provider to assess the process and control environment, uh, and the robustness of information that is available in the information system. So net, this would be a very key and a very interesting thing to watch out as far as 23-24 is concerned, being the first year of mandatory reasonable assurance on BRSR core. Let's talk about few more. If you are a debt listed entity or an entity having non-convertible securities, then what SEBI LODR requires that on a quarterly basis, the listed entity is supposed to obtain a certificate from its statutory auditor on security cover, debt governance, and similar matters. Again, the assurance framework would be the guidance note on certificates and reports. The requirement to obtain the certificate has been prescribed in Regulation 56(1)(d) of SEBI LODR. Now, if you would look at the boxes below, the requirements vary from quarter on quarter. So if you would look at Q1 and Q3 versus Q2 and Q4, the reporting requirements for the auditors are a bit different, though it overlaps, but there are certain nuances. So as far as Q1, as far as all the quarters are concerned, Q1, Q2, Q3, and Q4, the auditor is required to certify the book value of assets at the end of each quarter. So this verifying the book value of assets remains unchanged across quarter. Now coming to covenants, if you would look at Q1 and Q3, the requirement is to certify only the financial covenants, whereas in Q2 and Q4, that is on a half-yearly basis, the requirement is to certify covenants for all the covenants which the entity has entered into. One specific requirement, which is applicable only on a half-yearly basis, is to certify whether the entity has maintained 100% security cover or the higher security cover as far as the offer documents are concerned. So, so in a nutshell, the debenture trustee would require the entity to obtain the certificate from the statutory auditor, which will in turn be an input for the debenture trustee when they supply or when they submit their certificate to the stock exchanges on security cover and covenant related matters. If you would look at the procedures, normally I would expect the practitioner to obtain the board approved financial results of the company, trace the book value of assets from books of accounts underlying the financial results of the entity, obtain the list of covenants, especially the financial list of covenants, verify whether financial covenants like EBITDA have been met, whether there have been a default in payment of long-term borrowings, whether the computation of EBITDA uh, and its and the similar amounts can be traced from the financial results, whether the reserves of the entity are being considered as far as the financial results are concerned. The practitioner should obtain and verify the credit rating of the entity. Lastly, they should also trace from the bank statement whether whether the payments have been made. Moving to the next certificate, if utilization of funds. So if you would look at uh, the listing companies, they might uh, take they might take funds from public to meet certain objective. For example, they might raise funds to set up a capital project, or to repay existing borrowings, or for other working capital purposes. So if it is so, then Regulation 32(5) of SEBI LODR would require the listed entity to annually obtain and prepare a a statement of funds, and assess whether the funds have been used for the purpose for which they were obtained. So, for example, if the offer document mentions that the funds have been raised for the purpose of a capital expansion, whether funds have also been utilized in that fashion. The statement is required to be prepared by the entity, and similarly, the auditor is supposed to provide a certificate on such statement. Again, the guidance note on certificates and reports of ICAI would be the framework based on which the auditor would give this certificate. If you would look at the key considerations, the auditor would verify the amount capitalized pertaining to capital expansion. We took the example of capital expansion, and hence you will find this reference. They would trace and agree the amount of payments made to vendors, bank statements, lenders, etc. They would also obtain representations that there has been a change in uh, in in the agreements or amendments thereof to the agreements or not. They might also obtain external confirmations as far as cash and bank balances are concerned, and based on that, they will give an opinion or a conclusion whether this statement prepared by the management is appropriate. Now, moving on, the last two certificates, uh, buyback of shares. Again, this is a very quite common phenomena which I have experienced from a listed entities are concerned. What we will all know that buyback regulations govern the buyback of shares or any other securities as far as the listed entity is concerned. Now, what the regulations specifically mention is that these regulations apply only if the buyback is more than 10% of total paid up equity share capital and free reserves. Why is this reference important? Because all the certificates and information which a listed entity is required to collate is for sending to the shareholders. Now, these information are to be sent to the shareholders only if the buyback is more than 10%. So the frequency of the certificate would be once. It will be at the time of each and every buyback. Again, we would use the guidance note on certificates and reports to provide assurance. If you would look at these three boxes, I have tried to highlight what would be the auditor responsible for. Now, the auditor is required to state whether they have inquired into the affairs of the company, whether the amount of permissible buyback is properly determined and is accordance with SEBI buyback norms. They're also supposed to verify whether the board of directors on reasonable grounds have formed a view that the company would not be rendered insolvent from a period of 1 year from that date. So again, that's a very good support which the auditor would need, because as we all know, the assessment of solvency might require significant judgment, and unless there is a support from the management side, it would be very difficult for the auditor to preempt whether the entity would continue to be solvent for a period of 1 year from that date. So three things: inquiry into the affairs, amount has been determined correctly, and whether there is representation by the directors regarding the solvency of the company for the next 1 year. What we would all discuss now are the key differences between the SEBI buyback norms and Companies Act. So Companies Act, as we all know, as far as the buyback norms are concerned, they would apply only to unlisted companies, whereas the SEBI norms would apply to listed entities. Now, one very key difference between the Companies Act and SEBI norms is the baseline on which the computation is made. So if I have to talk about SEBI, the limits are computed based on consolidated financial statements, whereas under the Companies Act, as far as unlisted entities are concerned, these computations are made on standalone financial statements. Again, an interesting difference. If on the date of buyback, let's say I am doing a buyback on February 2024, what the Companies Act says is that on the date of buyback, your last audited accounts is more than 6 months old from the date of buyback. In that case, please obtain a limited review report on the financial statements, and based on that financial statements, you compute the amount of buyback. What I would like to also highlight that as far as the SEBI norms are concerned, this requirement have not been specifically stated. So as a practice, what I have seen that the entities have used the last audited financial statements while computing the limits for buyback. Again, coming to the practitioner or the auditor's consideration, they would obtain and read the standalone financial statements and audit report of the entity. They would inquire into the state of affairs of the company by looking at the financial statements. They would look at if there are any observation or comments that have been made by the auditor in their report. They would also look at the articles of association of the company to ensure that the article permit buyback of shares or other securities. They would also trace the components of buyback, for example, the share capital or the reserves and surplus from the financial statements of the entity. They would verify the minutes of the board of directors where they would have proposed the buyback of shares or other securities. They would also state in the minutes of the meeting whether the buyback in the view of the board of directors is in compliance with the SEBI norms or not. Most importantly, the auditor would also obtain the minutes of the meeting of the board where the board will specifically comment whether they have formed a view regarding the solvency of the company within 1 year from the date of buyback. So again, a common phenomenon, I'm sure you guys would have encountered certification on buyback, but I thought I'll just highlight, considering that there are certain differences between the Companies Act and the SEBI norms. Well, the last topic which I would like to pick up, I think Nitin mentioned about the scheme of arrangements and the accounting treatment. Now, in certain cases, what is also possible is that an unlisted entity gets merged into a listed entity and uh, through a scheme of arrangement. And when the listed entity would issue shares to the shareholders, those shareholders will automatically own the shares of the listed entity. So in that case, there is a pricing certificate which is required under the regulation 37 of LODR, which will have a cross reference with regulation 164 of the SEBI ICDR norms. ICDR, as we all know, is the regulation for capital raising and disclosure norms. So the frequency of this certificate would be as and when this type of transaction happens. And again, the assurance framework would be the guidance note on certificates and reports. Now, in this case, let's assume there is a listed subsidiary and there is a listed parent, and there is an unlisted parent. Through a scheme of arrangement, the unlisted parent gets merged into the listed subsidiary. So in that case, the regulation 37 read with regulation 164 of ICDR would require the auditor to assess what is the relevant date for the purpose of this transaction. At what date the pricing of the shares of the listed entity should be determined. Generally, the relevant date or the cutoff date is the date of approval of the scheme of arrangement by the board of directors. Now, after the date has been determined, the auditor is required to certify whether the price at which the shares would be issued are within a particular range. For example, is it at the minimum the 90-day trading or 10-day trading days based on the volume of weighted average prices of equity shares that has been quoted on the stock exchange. Again, this is a, a very good way to find out the price of that or the value of that entity as far as the shares are concerned. And these 90-day trading and 10-day trading are only a mechanism to identify the value of that entity on the particular date. Now, from a practitioner's consideration, the auditor would obviously note the relevant date. They would obtain the approval of the scheme of arrangement and read the scheme of arrangement. They would verify whether the computation of minimum price of equity shares is in accordance with the pricing formula, which has been prescribed under the SEBI ICDR. The auditor would also obtain and read this statutory register of the company and verify whether the shares are fully paid up. They would verify the board resolution which approves the scheme of arrangement. They would also obtain confirmation from the share registrar confirming that all the shares are held in the name of the entity. So net, a very interesting certificate, which not only deals with a financial number, but a non-financial number, which is basically the trading prices of a particular entity. So that's all I had. I would be glad to answer any questions, if there are any.
Yes, sir. Thank you so much, CA Nitin Gupta ji and CA Nilanjan Paul ji, for sharing your knowledge, sir. Your insights and expertise made a significant impact, and we are grateful for your contribution today, sir. I'm sure that participants have definitely learned something new from you today. I once again thanks both of you, sir.
Thank you.
So,
Thank
first
you.
question is, sir, can the auditor certify the net worth of individual requested for son-daughter US visa purposes with reference to the recent mentioning to whomsoever it may concern on a certificate? Is this a professional misconduct as per ICI?
Let me answer this.
Okay, sir.
Okay. So the essence of this guidance note is that it is now no longer open-ended certificate where the title is to whomsoever it may concern. So if the chartered accountant who is issuing the certificate, they are putting in the certificate that they are complying with the guidance note, which is one of the requirement. So in essence, yeah, it should not be written addressed like that to whomsoever it may concern. It should be addressed to the concerned department or the authority, and then it will flow. And then stating the other terms, what we have gone through through the deliberation, what all is mentioned that given in the guidance note, that all should be included as a part of that certificate. So the statement, which is like the format which is defined by the regulation or by the requirement, so that can come out in that statement, but the main certificate essentially will cover all those mandatory reporting requirements.
Okay, sir. Thank you. Sir, next question is there any specific list of certificates required to be given or issued by a statutory auditor while completing the audit of a listed company?
Should I take it, Nitin?
Yeah, we both can
Sure. Sure.
so one like the for the listed companies per se, it will more fall like come out from the SEBI requirement, LODR requirements. So don't think so one can find the exhaustive list of all the certificates at one single place. So again, need to work upon what is there in these regulations. Then comes the other regulations also. So it will be a mixture of various regulation put together, in my view. And Nilanjan, you can add more from a
No,
practical
I completely agree, Nitin. I think it will be very difficult to put down a list, forget comprehensive, exhaustive, inclusive. In my experience, it would be very difficult to pin down that these are the so-called certificates which a listed entity would require. It is not that it is not mentioned, but the way the listed entity functions, it is required to comply with numerous regulations. So I think in my presentation we looked at LODR, we also looked at the buyback regulation, we also looked at the ICDR regulations. So imagine that if a listed entity has to look at not only one but a plethora of SEBI requirements, uh, and that too those certificates might be a very need based or a specific situation kind of a certificate. So to highlight or to prepare any list, I think it would be too much, to have a list like that.
And then for an auditor, I would say otherwise it would be good not to have that list, because then practically one can just restrict to those certificates only. So all the need-based certificates, they can come here and there, and what all is required as per the regulation. So as a practical experience, both the auditee and the auditor, they are aware as to what all certificates are required to be exchange like issued by the auditor. So that will come, but again, nowhere one can find the exhaustive list of all the required certificates.
I agree.
Okay. Next question is, sir, any example of management service which cannot be performed by the issuer of BRSR?
Any example of management service?
Management service which cannot be performed by issuer of BRSR.
So let me give a very straight and simple answer. What SEBI is saying is that you can only give assurance services. So other than assurance services, a person who is proposed to be engaged as a BRSR assurer, he can't give any other service. As simple as that. So services like tax audit of financial statements, third-party certifications, they will fall as assurance services. So SEBI is trying to say that if you are only providing these service, not only to me, but even to my group entities, then only you are eligible. any services which is not assurance service, I'm sorry, I will not be able to engage you as a assurer for BRSR.
Okay, so last question is, sir, any certificate to be issued by an auditor when a private limited company is going for an IPO by converting it to a listed company? So any requirement to be done by a continuing auditor?
We can take this both, Nitin, you and I. I
Yeah.
think from a experience perspective, what I have seen is that first of all, a private limited company cannot list itself, right? Because you have restrictions in number of shareholders, the way your articles are framed. So the logical progression is that you convert from a private to a public company, right? And then you list yourself. And by listing, I mean the equity shares. I'm not talking about debt listing, commercial papers, all those things. So that is the natural progression. Again, as I think both Nitin and me alluded, that it will be very difficult to have one set of a certificate list for an entity for being listed. But having said that, if you would look at the SEBI ICDR regulation, there are certain common certificate which everybody would expect. For example, there is a certificate on eligibility condition, whether you meet those eligibility condition, regulation 6.1 of SEBI ICDR. There is also a requirement to comment on the tax benefits which are available to an entity. If the entity has taken loans and they expect the fundraise to repay those loans, then you have another set of certificates. So again, Shilpi, I think it would be difficult, but I think these three I have seen to be more commonly used. Nitin,
Yeah.
over to you.
Yeah. So when they initiate the process of listing, so they are required to file draft red herring prospectus, what we called as a DRHP, as a part of before the DRHP is filed with SEBI. So the lead managers who are there on the issue, they would expect a laundry list of certificates which would a statutory auditor would need to issue. So yes, over there they will be provided with the list of the certificates, and in my experience, again it goes around say 25 to 30 certificates, as long as that much certificates, and at different stage, at draft red herring stage, like prospectus, then once that has been approved, so at the end when they will file the not red herring, the actual like prospectus, that time also again the entire set of those certificate at a subsequent date, that also will be required. So the lead managers who are engaged by the company, they will share the list of the certificates along with the format. But mind, some of the formats, they are not at all in accordance with the guidance
Yeah.
note. So that to and fro happens between the auditor and the client with the lead managers. So ambically it is being like sort outed, and then those certificates will be issued.
Okay. Sir, one more last question. Can a CA certify investment certificate for the purpose of subsidy when books of accounts not maintained by client as he is agriculturalist?
If the books of accounts are not maintained, being an so how the computation will come out, that's the question. So it's not for the auditor but for the company, how they will compute that. If there is an say mechanism or some formula defined for that calculation purpose, which must be there in those underlying documents for the purpose of this subsidy. So if that is there, then it will be easy for the chartered accountant to issue the certificate.
Nitin, if I can just add to what
Yeah, please.
what you just said, I think we would need some more information to that question before you respond, because if forget the auditor, if the management itself doesn't have the information,
Right.
how will they be able to satisfy the requirements of PLI or whatever that scheme is, right? We as a practitioner would come at the second stage. If the preparer himself doesn't have a data, then I'm sure our report would have certain implications.
Sorry to interrupt, sir, but the person is not a company, he is agriculturist. I'll repeat the question. Can a CA certify investment certificate for the purpose of subsidy when books of accounts are not maintained by the client as he is agriculturist?
So
This is the question.
Shilpi, it doesn't matter who the legal entity is. It might be a company, it might be a partnership firm, it might be LLP, it might be an individual, but as long as he is the one who is going to use that document to get something from the regulator. If that underlying information itself is not prepared, then I'm not sure whether the assurance provider would be able to do justice.
Right.
Okay. Anil, sir?
Thank you so much, sir, for such a wonderful deliberation. How AASP thanks over Nitin ji for spending their time for our members by apprising their expertise, by sharing their expertise on various certificates and reports which are required for special purpose. So thank you so much, sir, for sparing your time. And I also thank Shilpi ma'am for sparing her time and wonderful moderating this webinar for WSP of ICI. Thank you. Thank you so much, Niranjan ji. Thank you
sir.
so much. Good evening.
Thank you,
Thank you,
sir.
sir.
Thank you.
Thank you, Anil ji.
Thank you, sir.
Thank you all. Thank you to participants. Thank you.
Thank you.